All right, guys, welcome to day one of boot camp. Day one of boot camp is going to go over things very aggressively and very, very quickly. Make sure that once you guys are coming in, you guys are muting yourselves and that you guys are raising your hand or typing in the chat for questions, okay? Now, day one's going to be very aggressive, and it's going to be the first foundation of you guys. It's going to be the first foundation to you guys becoming more profitable traders. And this isn't just taking a signal and relying on somebody else to give you a signal. This is the trip to you becoming your own signal, because at the end of the day you need to become your own signal, or else there's no point in being mentored, right? There's no point, because you need to learn how to trade, or else why did you join this business, right? Okay, first things first, we're going to go over things very aggressively. So if you guys want to take notes, that's completely fine. I ask you not to record this session, as this is my own personal intellectual property. And I also want to make sure that if you guys have questions, to stop me and make sure that you get it, because each and every topic will build on itself, and it was strategically placed from day to day to make sure that you are building on each topic. Okay? So I'm going to make sure that you guys know what you're talking about and understand it before I continue. Moving on. Now, first topics. We're going to be going over market structure from A to Z. This does not mean trend lines. This does not mean support and resistance. This does not mean supply and demand. I'm going to rip out every single concept that you've ever learned, even from basics training, okay? And I'm going to replace it with something that actually works, okay? Significant candle movement. A lot of people sit there and stare at charts. I used to do that too. I'll tell you things that I have found from my times staring at charts. Spotting liquidity. At the end of the day, people need to learn that banks move the market. And if banks move the market, liquidity is what runs it, okay? And if liquidity is what runs it, then you need to know how to spot it. Bank logic is next. What is the algorithm? A lot of people don't know what actually moves the market. I'm going to tell you today. Order blocks. Many people have no idea what order blocks are, and that's completely fine. Normally, a lot of gurus, a lot of traders, a lot of people don't teach you what order blocks are. Why? Because they don't know, okay? And I'm going to teach you how I was taught to trade order blocks. Okay? Next is trade management. Trade management. A lot of people have no idea how to manage their trades. A lot of people just sit there and take a signal and hope they win. That's not how you do it. I'm going to teach you what exactly are the 4 fundamental laws of trading and how you can increase your profitability just by increasing your risk reward. Your trading times and schedules. One thing that I have noticed is that a lot of people have no idea what the actual trading times are or how they should schedule their day. Next is top down. What is top down? A lot of people think it's just about analysis. It's a lot more than that. Okay, so getting started. Does anybody have any questions, any concerns, anything before I get started? Because this is going to be very, very fast, very aggressive. Make sure you guys mute yourselves as soon as you come in and ask questions in the chat, because there's a lot of you. Yes, Isaiah or IC is going to be the one helping me out on this call. If you guys have any questions that he can answer, he will answer them for you. Okay, and he will help you out. He's one of my best traders, and I brought him onto the business to help you guys out. Okay, so now we're gonna go ahead and get started. Market structure. Who can tell me what market structure is? What is market structure? A lot of people think they know what market structure is, but they have no idea what it means. So what is it? What is market structure? Who can tell me? Quick explanation. It doesn't matter who you are. You can unmute your mic and try to talk, because I know typing that out is going to take a little bit.
What the market is doing based off of price action?
What the market is doing based off of price action. Good answer. Good answer. Anybody else? And if you don't know, that's completely fine. Just type in, I don't know. That way I gauge on what you guys know and what you guys don't know, and I can adapt towards you guys. This is about you guys, not me. Not completely sure. Okay, that's completely fine, Daniela. I don't know. I don't know. Okay, that's completely fine. A lot of you weren't taught that. And I'm going to teach you today. That's why I was brought here, to teach. So we're going to do that. Next. Who can tell me how a candle moves? Whenever you stare at a chart, right? Whenever you stare at a chart, a lot of times you see movement that a candle just flickers. It goes up and then it goes down. It goes up and then it goes down. Let me show you an example. A lot of times, the biggest mistake that people make is trying to stare at a chart. And let me tell you why that's a bad idea. If you know that price is going to go in a certain direction, and that will come way later in your career, do not expect to try to do not expect to come out of this, out of today's bootcamp, meaning like today's session, out of day 6's session, you'll be able to spot your own trades. But right now, you are trying to learn the basis, the foundation. So let's look at this. Say a candle is going bullish, right? And you know that it has to turn around and go bearish. Actually, let me draw that a little bit higher so I have a little more space. And you know that price needs to go bearish. Why? Because you have an order block. Why? Because you just filled a liquidity void. Why? Because you have to fill your distribution schematic. Whatever the case may be, right? Price needs to go down. You know it has to go down. So what do? A lot of people, what they end up doing is they end up placing a high-ass lot all the way down here. When market hasn't given them an entry, when their entry is very sloppy, and they end up going in drawdown. And they end up staring at their chart, watching a candle, and these next few drawings are all going to be the same candle, just a few seconds apart. They're going to watch the candle open bullish, then they're going to watch it kind of go bearish. Whoops, that's not a bearish candle. They're going to watch it go bearish, and then they're going to watch it go bullish even further, and they're going to freak out. So this is all the same candle, just a few seconds apart, right? So all of a sudden it's bullish. Oh, damn, my entry's even redder, right? Because you're in a sell. My entry's even redder. Now it drops down. Hope. Hope is one of the most dangerous emotions as a trader. Why? Because you hope this trade will go back to your entry. You hope it won't go any higher. You hope the banks will have mercy in your account. But they don't. And you know what? They push price exactly where the algorithm wants them to go to, which is up here. And by then, a lot of people, you know what ends up happening to their account? It gets blown. How many people have blown an account in this chat? We're going to change that. Okay? So, we're going to come back into this in just one moment. There are 4 things that I need you guys to know. These are the 4 fundamental rules of trading. The 4 fundamental rules of trading. Okay, and I'm going to go ahead and make this as big as I possibly can. And I'm going to turn them red. Rule 1. Price is fractal. You can tell me what fractal is. And I know some of my people are wondering, well, why am I seeing this again? I saw this the first time. Yes, but you need to make sure that these are drilled into your head. Who can tell me what fractal means?
It means lower time frames build the large ones.
Right, it means lower time frames build the large ones. Meaning that price, no matter what happens on the higher time frames, the lower time frames will tell you first. Okay? Does that make sense to everybody? Perfect. Next, second rule. Liquidity is king. Why do you guys, who knows what liquidity even means?
It's money.
It's money. Good, perfect. It's literally money. Now, who can tell me, we're going to pause at this rule. Who can tell me who actually runs the market? Who moves it?
The banks.
The banks. The banks use the market. But what actually delivers price?
The hedge fund, stuff like that.
So essentially, I heard somebody say the right answer. So essentially, we live in a pyramid. Okay? We live in a pyramid Well, we're at the bottom. We are retail. We are the bottom. We are the ones that are the bottom feeders. A lot of people see like 100,000 profit, 100,000 profit, 200,000 profit. That's nothing to the banks. They deal in the millions of lots. Okay. First is us, retail. We're the most numerous, but we're also the cheapest. Next, come in the hedge funds. Next, come in the funds. After that, come in the smaller banks and brokers. Let me actually make sure that I get these smaller so you guys can see that. Small banks and brokers. Perfect. And up here, who do you guys think is up here?
Major banks.
Big banks. Perfect. Now, these major banks are the ones that have the most liquidity. Let me explain to you something about money. Liquidity is money, right? There is a finite amount in the world, which essentially puts this in a weight model. In economics, a weight model is essentially showing that whoever holds the most weight or the most share or the most percentage is the one who essentially controls the whole market. Same thing happens with stocks. With stocks, there's a limited amount of them, giving them a value. If you own 60% of stocks, you can move the market drastically. Okay? If you own, let's say, 70% of the market, which the big banks do, if not more, how much of an impact do you think the big banks will have on the market? How much of an impact? An enormous amount of impact. Okay, and a lot of you, some of you guys may be saying, well, this is kind of boring. You're gonna need to know this so you can understand the fundamentals beneath your trading. Okay, before you even hit a chart, you need to understand this. Okay, but above all this, there is some supreme godly entity that runs all of this. Because as people, we make mistakes. This thing helps correct our mistakes so that the market doesn't just crash out of nowhere. What do you guys think this is? Who can name it? Can anybody name it? The what? Nobody knows?
What was the question?
I'm saying,
Yeah,
what is the one thing that essentially corrects human mistakes and moves the market the way that it moves?
Algorithm.
The algorithm.
Oh, yeah. But
Some people may say, why does the algorithm or the algo, perfect, why does the algorithm matter so much? You would not believe how extremely difficult managing a market, much less an exchange of currency, is. It's extremely stupidly hard. So obviously, the market is going to have an algorithm in the back. The stock market has an algorithm in the back. It only makes sense that the Forex market does as well. This algorithm essentially prevents the market from falling off the face of the earth, and it also responds accordingly to different news. It calculates in news, it calculates in reports, it calculates in crises, it calculates in war, all these other things, because the algorithm is essentially dynamic. It moves with the weight of the banks. So the banks know how to exploit the algorithm in their advantage. Okay, that's how they make so much money. So next, we're going to go on to our third rule. Who can tell me what my third rule is? People that have been on these calls with me before.
Time and price.
There you go. Time and price. Now, a lot of people may not understand this, but time and price correlate. Who can tell me why time and price correlates? And if nobody can tell me, that's completely fine. Let me just get you the answers so we can continue moving on. The reason why time and price correlates is perfect because of trade sessions. Trade sessions essentially just means that the banks of that side of the world are open at that point in time. If banks at that side of the world aren't open at that point in time, there's no reason for certain currencies to have any liquidity at all. Liquidity, or sorry, volume. Volume, and you can write this in your notes, volume is simply how much money is in the market at the moment and is being traded between currencies, okay? So time and price correlate because different sessions hold different volatility or volume. They hold different volume. That is exactly why time and price correlate. And I will show you many, many examples of this in the future. The fourth law of trading is supply and demand rule. Why is this? Because in supply and demand, right, a lot of people use supply and demand, quote unquote, as a trading strategy. This is not correct, and they're using it in the wrong sense. Okay, they're using it in the wrong sense. So I'm saying supply and demand in the sense that you as a trader, right, for every buy that you put in, there has to be a willingness to sell. Okay, the market moves in such a way that for every buyer there must be a seller, or there must be a willingness to sell. And that it's very, very simple concept because money moves like that. For every buyer, there has to be a willingness to sell, and for every seller, there has to be a willingness to buy. And I will show you this later when we get to bank logic. Does everybody understand this?
One question. What did you say the definition of value was? Volume?
Volume is how much money is being traded in the market at one time. That makes sense? Any
Yep,
other
thank you.
questions? If there are no other questions, we can go ahead and move on. All right, let's go ahead and move on. Next, let's look back at our schedule and see what we were missing. Market structure from A to Z, so we're still here. What do you guys think? How do you guys think the market moves? In a line? And I'll actually give you a multiple choice question here for you guys. How do you guys think the market moves? And we're going to do multiple choice. So let's go A, in a line, or in a general direction. In cycles. In patterns. Whoops, let me type C. In patterns. Or D. In trends. You guys can go ahead and comment your answer in the chat. And that way we can be a little bit more interactive with each other. Okay, and I'm going to continue to use these multiple choice questions to kind of engage with you guys. B, C, C. I see a lot of C's in patterns. B, cycles. B, B, okay? Don't just copy off other people. Make sure you guys understand why you're giving that answer. Let's get some more people in the chat. Let's get at least 5 more answers. D, C, B, you mean? Okay. You feel like C or D, TBH? Okay. B. All right. Well, I'm going to reveal the answer. And the answer is B. The market moves in cycles. Why? A lot of people don't know this. The market doesn't move in a general direction. A lot of people used to use trend lines. A lot of people used to use support and resistance. But the market doesn't move horizontally, and it doesn't move just vertically. It moves in a dynamic cycle. Okay? It doesn't just move in a general direction, because then we could essentially say, oh yeah, EU is buying, and we could just draw a trend line and it'll just do this. That's not what it does. Look at EU. It doesn't do that. What does it do instead? It does stuff like that. Well, I don't know why it just don't click, but it does stuff like that, right? There's reason to this madness. There's reason to it. And a lot of people don't know that it's because the market moves in cycles. It doesn't move in patterns, because a lot of times when you see this double top, it does that. And I can tell you exactly why it does this. But a lot of people still want to follow these retail teachings. A lot of people say, oh, double bottom. And it ends up doing this, right? Or double bottom, and it ends up doing something like that. Why are these patterns so inconsistent? They're inconsistent because they're based out of nothing. They're not based behind any proof. And trend lines, to me personally, trend lines are a myth, because the market won't move in one general direction. It won't just be a break and a retest and continue on. There has to be multiple confluences behind your trade, okay? And I'll explain why here in one moment. Now, there is something in the market, right, that I have to go over with people from my chat as well, right? People say that the market likes repeating itself. It does, but there's a reason why, okay? There is something that a lot of people don't know, and I'm going to teach you guys today. And I'm going to go over it because a lot of my people, this is exactly how I'm teaching my people. Who can tell me what Wyckoff logic is? Who can tell me what Wyckoff logic is? And if you don't know, that's completely fine, but say it. Okay, let's go ahead and explain it to you guys, okay? Wyckoff logic essentially states that the market moves in a cycle. The market moves in a cycle because price doesn't stay in one single place. It doesn't just go in a trend line. It doesn't just go in a general direction, and it doesn't follow retail patterns. How the algorithm works and how the price delivery system works is essentially there will be a high and a low, which price will usually revisit. And this is going into bank logic. Let's consider this position real quick. Let's say you're just coming in like this, right? You shoot up. These are the two phases of these are the two phases of the market, okay? And these two phases of the market are called contraction and expansion. Whoops, up here, not there. Whoops. Expansion. Up here is also contraction. Let's change the font for these. These two phases exist because the market is like a spring, okay? It has to gather liquidity. Banks can't just move on borrowed money or on their own money. For example, let's say all of us were with Bank of America. If all of us went to Bank of America right now and told them, hey, give me all my money and my savings, they would tell you absolutely not. All of us, right? If all of us went, if all 800 of us in the Discord went to Bank of America and said, hey, I need my money back, They're going to say absolutely not. Call the cops and close their physical position. Why? Because of the fact that they don't have the money on them. They have something called standing liquidity. Standing liquidity is essentially how much money a bank can spend or use at one time. They have these costs because every day people go to the bank and borrow $60,000, or they borrow $10,000, or they borrow $20,000, or whatever the case may be. Each bank needs to have a certain threshold of money that they can give out each day. This is given to them because of their positions in the foreign exchange market, because that's what they have. They have money. And if they have money, they're obviously going to put it in the market to make more out of it, right? So since price works like a spring, this spring collects liquidity. How does a bank collect liquidity? A bank collects liquidity by hitting retail stop losses, by hitting hedge fund stop losses, by essentially taking out people's positions that are buy stopped or are sell stopped. Does everybody understand what a sell stop is or a buy stop is? Because you guys are going to need to understand what those are. Let me go over it just in case. Let's say that you put a buy stop right here. It's almost the same as a limit or a market execution. It's a type of market execution that essentially say the price is right here, right? If you put a buy stop right here, your broker will enter you into the market as soon as price touches and crosses the market. As soon as price touches this position and continues above it, that is called a buy stop. Now, the opposite is true when you have a sell stop. Let's say that, you put a sell stop down here, then the market does there. You would be entered into the market right there, okay, to catch the quote unquote breakout, quote unquote. It's a myth, but I'll explain to that later, okay? So every single time a bank takes a stop loss or it takes a position, remember the fourth law, how every single time that there is a buyer, there has to be a willingness to sell. And for every seller, there has to be a willingness to buy. Essentially, once banks hit those stop losses, their positions that they just stopped out just became their new positions to go in the correct direction. Those are called shakeouts, okay? And I will show you an example of them here in one moment. Let's say that out of this contraction and out of this contraction, right, there will always be an expansion in the middle, okay? It can't just be contraction, 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 contraction. It has to be contraction, expansion, contraction. What follows next?
Expansion.
Expansion. Expansion to the downside back here. And what do you think happens down here?
Contraction.
Contraction once more. Right? Does it always happen exactly like this, where it like goes exactly back down to the bottom or whatever? No, it does not always happen this way. However, what does happen, and sometimes what you will see happen, is mitigation of losing positions. And I will explain to you. Now we have crossed into bank logic. Let me see if I can find it. It was from yesterday's boot camp. It was from yesterday's training that I did with my team. Do you guys remember what chart I was looking at? I think it was it GU? Let me see if it was GU. I think it was on the daily. Let me check it. Just to give you guys a good example of this. Well, it was actually GJ. Where was this? I'm just looking back for the example that I was currently looking for. That is actually a good example. So you guys see how price was here at one point? This is contraction, right? Contraction, which then expanded, contracted once more, expanded downward, contracted again, expanded upward, contracted again right here, and then expanded all the way back down to complete its cycle. Another example of this would be GJ, in which we had it on the it was a weekly, not the daily. Right here, in which it contracted down here, expanded, contracted, expanded, contracted once more. And now this is a variation of contraction. Now this variation of contraction will be something that I am about to teach you now. However, let's go down here. Let's go down here and actually let me draw one up for you guys so we can actually draw it and look at it a little bit clearly. Let's say that banks come all the way down here, right? And they start down here from this contraction position. Now it shoots back up and it starts contracting again. What do you think that they had to, what orders do you think they had to place down here to make price shoot all the way down here? What orders? What marks it? What type of market execution?
Buy.
Buy. Right, obviously they had to place buys there. So let's say they placed a total of 600. Actually, let me lower the font on that. That's giant. Let's say they ended up placing a total of 600 million lots in a buy. Okay, and these are actually pretty close to the actual numbers. 600 million lots in a buy. Now let's refer back to law number 4. What is our fourth law of trading? Who's been taking notes?
Supply and demand.
Supply and demand, meaning that if there is a buy, there needs to be a willingness to sell, which means that banks, knowing this and preventing a market crash from it just spiking up into higher depth, into higher heights, what are they going to do? They need to hedge their position with sells, or else this buy isn't going to go anywhere. The buy needs a sell to rise, okay? Even if it's a small one, it needs a sell. Let's say they place 200 million lots in a sell. They place 200 million lots in a sell. Perfect. Now, once they do this, expansion happens. Now, on the way up, they put, a couple more buys, a couple more sells on the way up. Now, we've reached this position. It's contracting again. This specific variation of contraction is going to end up going down, and they want to go back down. Why do you think they want to go back down in this position? Why don't they just want to keep going up? Why can't the banks just continue to go up?
They can get the liquidity.
Okay.
Or is it to knock all the retail traders out?
To knock
That bought.
retail traders out? Okay.
I don't know.
But why would banks even want to come back down if they're already so deep in profit on their buys?
Algorithm?
Algorithm, okay.
Orders.
Think about how many lots they placed in a sell.
Mitigate losses.
Mitigating losses, perfect. So up here, obviously, they need to know that they need to take profit from these 600 million lots in a buy, right? But they also need to place more buys up here. Why do you think they need to place more buys down here if they need to bring price down this way? If their target is down here, why do you think they need to place buys here?
So they can get the sell orders.
Right.
Supply and demand.
Perfect. Fourth law, supply and demand, right? The fourth law states that for every single buyer, there needs to be a seller. And for every single seller, there needs to be a willingness to buy, or else the sell goes nowhere, okay? There is no conservation price. So let's say they place 300 million lots in a buy. They took profit from this right here. So now available to them, they have 600 million lots in profit plus all of their profit up here. This just made them millions of dollars, if not billions of dollars. Okay, boom. Now what do they have left? They have the 200 million lots in the sell down here, and the 200, then the couple other million lots that they placed on the way up to continue pushing price higher. Right now, they also have to have, let's say they put 900 million lots in a sell. 900 million lot sell. Perfect. Now when you have this 900 million lot sell, where is price going to go if there are 2 times more sellers than buyers? Remember that this is a weighted market. So whoever holds the most positions is where price is going to go. Where is price going to go if these are the statistics?
Down.
Down. Perfect. So now price comes down to their target. What do you think they do with this target? They take profit on what?
Their cells?
Their sells. They take profit on their sells. Now, what do you think happens in this position? What do you think they do here?
Make price go back down?
Take
Well,
it out
no.
the way.
They take these losses out, right? At break even. It went back to their break even or at a very, very small loss. So now instead of losing, you know, a couple $1 million, they only lose a couple thousand, which is fine for them. They just made a ton of profit from here to here. A ton of profit. So now they just take these out at break even or at a small loss. And now where is price going to head up to? Where does price need to go back to?
Up.
It needs to go back up.
Price needs to contract and complete its cycle, taking out these 300 million lots in a buy. This is why I tell you that trend lines are fake. Because this doesn't necessarily need to go all the way down here. It could stop right down here. They still get out at a massive, they still get out at a small loss compared to all the profit that they made.
Yeah.
The game of trading is the banks capturing their own liquidity, covering for their own mistakes, and essentially capturing as much liquidity as they can and getting out, mitigating as many losses as they possibly can. Mitigating is simply lessening. Okay? Mitigating is simply lessening. Now, this cycle has now completed. This is a complete cycle. And now price can push on higher if the banks want to push on higher, or it can drop from here and continue on lower. They can, you know, rise, and instead of doing all this and shooting up higher, they can do whatever they want at this position because the cycle has now completed. The cycle has now completed, and now all they need to do is mitigate these losses. So what they can do is they can mitigate up to 50% or 70% or 79%, right? And that is where structure comes into play. Because how are you going to know this? Well, you're going to know this based off of structure, based off of market structure. And that's exactly what we're going to get into. We're going to get into the meat and potatoes of this, okay? But I needed you guys to understand this before I even moved on to the schematics, okay? My people, Enrique, Angel, Isaiah, everybody understand this? Jazz, you understand this?
Yeah.
Yes, sir.
Andrew, how about you?
Yeah, I'm understanding.
All right, cool. So now now that you guys understand this, this is when we get into the meat and potatoes. So if anybody left, tell them, get back in here. We're getting into the good stuff. Okay? So
all that we just went over, that was all bank logic, right?
that was all just bank logic. There is way more to it, but I feel like some people are getting bored. So we're going to go ahead and split that into a separate part so that I can explain bank cycles later. Okay? And that'll probably be on day 2. But essentially, these 300 million lots in a buy right? They have to get mitigated, and they get mitigated by structure. However, how do you know that this contraction is going to go down? Or how do you know that this contraction is going to go up? How do you know that? Well, if you didn't have a trained eye, you wouldn't know. The sad reality of that is that you wouldn't know. Okay? This gives sense to as to the market. Perfect. I want you guys to understand why the market moves as it does before you guys even get to the part that is coming up. Okay? The next part is going to be something that a lot of you guys may have seen thrown around. Wyckoff schematics. Wyckoff schematics are a variation of contraction. Richard D. Wyckoff was the one who was a trader back in the early 1900s and the early 1910s, and he worked closely with Jesse Livermore. He worked closely with J.P. Morgan. He worked closely with all of these guys who essentially founded and started both the stock and the forex market. They started it. Why? Because it's needed for an economy, right? It's needed. So the Wyckoff schematics, essentially, he studied under them. And this is also the time where Dow was a trader as well. There's also a time where a lot of other traders were coming up, right? But Wyckoff was by far one of the most superior. Why he was one of the most superior is because he essentially designed the market cycle. And he perfected it in such a way that you can tell because of our first rule of trading. What's our first rule?
Price is fractal.
Fractal. And I'm going to keep repeating this to you guys, but you need to understand them. Okay? Since price is fractal, that means that lower time frames are going to tell us what to do, right? But you need to go off of higher time frame structure. The first one that we're going to go off of, so keep these two in mind. Keep these in mind. They're going to be in a little box here in the corner. The first one that we're going to go over is something called accumulation. Okay, and accumulation essentially is short for a buy. Okay, a buy. So essentially, when you think of accumulation, you want to be thinking of a buy. A lot of people get accumulation and distribution mixed up, but we're going to focus on accumulation. This essentially means buy. And we're going to put AKA buy. Okay. This is the first schematic that you guys need to get down pat. There are many variations to this schematic, but you will not need to know these today. I will go into variation schematics on day 3. Okay? Accumulation essentially is found, usually, it is found at the end of a downtrend or at the end of a down cycle. Okay? And I refer to it as down cycle. Actually, I drew that wrong. Whoops. At the end of a down cycle. And I will draw a perfect Wyckoff schematic for you guys. Okay, this is a perfect Wyckoff schematic. And let me show you why. There are multiple phases to this, okay? And I will delineate them for you guys today, right now. This right here, this little sector right here. Actually, let me move the colors. Boom. These right here are known as PS or PSY. Okay, they're known as preliminary supply or preliminary support. Okay, you can know this as PS as well. And essentially, this is showing you that price has a willingness to stop and start contracting. This right here, it's its willingness to start contracting. Okay, this one right here is known as its selling climax. Why does price have a selling climax in the first place? In the first place, it has a selling climax in the first place because it has to reach a point where price no longer wants to go any lower. The reason why the sell climax exists is because that sell climax tells you, hey, this is where price stops and this is where the range begins. Okay. Now up here is known as the automatic rally. The automatic rally will essentially show you how price will move up, right? And respect the PSY. Usually the PSY is respected by the AR, okay? Usually. Sometimes it isn't, but that's a variation schematic, right? This automatic rally will usually be held into a position where the automatic rally will establish the trading range. Usually between the selling climax and the automatic rally will be an established trading range. And I'll show you guys what I mean in 1 second. Down here, we have our secondary test, or ST. Secondary test, or ST. If I can move it. There we go. Cool. Now from here, this is where the trading range is established. The trading range is established from essentially here, right down there, and here. A lot of people will say, well, James, why isn't this just support and resistance? It's not. A trading range is not support and resistance. Let me explain to you why. How many times in a range have you been caught in a range and all of a sudden you think that just because it hit this support and resistance and you sell and you get absolutely demolished by a poke out of the range, and then it drops back down and it goes your way? I've seen a lot of times that happen. When I was trading retail, that happened so many times I used to get frustrated and throw my phone. But this right here is an established trading range. It should not be something that you buy or sell. It should be something that you observe. Okay, so this right here is going to be the trading range. Perfect. Now because of this, what do you guys think this is? In my industry, it's called a shakeout, or it's called a buy model. Okay, a spring, perfect. It's a spring, a shakeout, or a buy model. Whichever one of those you hear. Some people trade smart money, they're going to call it a buy model. Some people trade Wyckoff, they're going to call it a spring. Shakeout as well. So let's go ahead and name this our spring. Perfect. Now our next is going to be our test. The test happens because you want to establish bullish structure. Okay, you want to establish bullish structure. Why does it return to the top of the trading range, or it goes somewhere near the top of the trading range, and then it drops all the way back down to the spring? Why do you guys think it does that? Let's think about it from a retail perspective. Say you did catch the sell. A lot of you were taught to put your stop loss in profit. So some of you guys may put your stop loss right there, maybe a little bit higher, maybe right here, right? And when price does this, the banks no longer need to pay you out your full amount. They just need to pay you a little bit. Not all that much, not for them. Now, what if you put your stop loss at entry and your entry was up here somehow miraculously, and you see price returning all the way back up to your entry? What are you going to do? You're going to close. They're going to scare you. Yeah. Oh, it almost reached your entry. Boo, right? And you're going to close. What are they going to do? They're going to take all the entries you just closed, and they're going to put them back into their account, and they're going to make up their losses in this sell. Why? Because it didn't reach, quote unquote resistance yet. So you can't sell it. No confirmation, no entry. But by the time you're looking for your 4th, 5th, 7th entry, or sorry, a confirmation, price is already all the way down here. So how do you catch entries like a sniper? How do you catch entries based off of a wick? Well, you catch them based off of these schematics. Oh, whoops. I did not mean to delete that. You get these entries based off of these schematics. And I will show you a perfect example a little bit later when we get to distribution, okay? So these springs, right, are usually tested. They're tested because banks have a lot of buy entries here. They know that price is going to explode violently. But for price to explode violently upward, meaning that they have, you know, say they have 900 times 2 million lots in buys. Fourth law, what do we have to have? Quick.
Supply and demand.
Supply and demand. But what does that mean? We have 18,000. We have 1,800 million lots in buys.
There has to be sellers.
There has to be sellers. So banks obviously need to sell. Right? Banks obviously need to sell. So what are they going to do? They're going to enter, say, 500 million lots in sells. Okay. Now, these tests, now these springs or shakeouts are mitigated because what do you guys think late retail is going to do right here? As soon as this quote unquote support breaks, what are they going to do? Sell. Late retail is going to sell. Okay. That's how a lot of people are taught how to trade. Trade the breakout. As soon as it breaks resistance, sell. As soon as it breaks resistance, buy. Or as soon as it breaks support, sell. Okay. People, as sad as this sounds, people who have who have $500,000 in their account, in their trading account, they trade this way because they don't know any better. Or they give it to somebody that has no idea what they're doing and they trade it this way too. So people are going to have sell stops here outside of this quote unquote support, right? And what's going to happen? Price never reaches it. Or price closes below it and they sell and boom, their stop loss just got clapped. Okay, so all these times price is catching liquidity. Here's another example of price catching liquidity. Because what is retail going to do in that position? As soon as it crosses out of, right, perfect. Actually, both ways. It's going to screw them both ways. Because as soon as this support gets tapped, people are going to start buying. But also people are going to start selling. So buyer stop loss just got hit. Sellers are 20 pips in profit, and then price violently rejects off and just smack their stop loss or their break even. So both ways, either way you trade this, you just got screwed unless you caught it from here or from here. Okay. And I'll teach you how to catch these in just a minute. Now, retail got screwed here. Retail also got screwed right here. Why do you think retail got screwed right here? Break and retest. Perfect answer. I love that. I want you on my team. Break and retest. It breaks and now it retests. No confirmation, no entry, right? What confirmations do you have? What confirmations do you look for? And let me give you a very, very quick tip. Overbought and oversold do not exist in the foreign exchange market. They exist in the stock market, not in the foreign exchange market. So RSI, stochastic, all that out the window. Aren't real. Okay. What confirmations are you looking for? Truth is, there are none because break and retest doesn't really work, right? But what ends up happening here is you get screwed both ways because you start selling, right? And a lot of people are afraid to buy because what just happened down here. Some people do buy. Lucky for them, they get in, right? Come all the way up here. It hits their support. Now they start trading. Okay, cool. Let them have their little money. Let them have their wins. This is something called the blackjack effect. Who is knowledgeable with the blackjack effect? A lot of people say that trading is addictive. Like, oh, I can't stop looking at my charts, bro. I can't stop doing this. Oh man, I'm looking at my charts at work. This is called the blackjack effect. Because the blackjack effect essentially states that as long as the banks, right, in this case, give you a couple wins once in a while, they can afford these wins to pay you out. As long as they give you a couple wins once in a while, what are you going to do? You're going to come back. You're gonna try to outsmart the banks. You're gonna try to be like, oh yeah, dude, I think I'm getting better. I'm getting better. And what happens? Your stop loss keeps getting smacked because the banks fed you a win once in a while, which is exactly what this is. And then from there, it gets tested. Now going back to this idea, what did it just do on this test? If they entered these positions, they entered them right on the spring, right? If these positions, they entered them right on the spring, what is this test doing? It's doing what to these losses?
Mitigating.
It's mitigating those losses. So now there are less losses for them to have to take in, right? There is no longer as many losses as you may think. So what are they going to do? They're going to obviously push back off of there. Now here they can add more lots. Say they only closed about, say they only closed 300,000 lots. Say they only closed 300,000. 300 million lots. Now they still have 200 million lots in sell, but it's not as much loss because they just mitigated a lot of it. Now they're going to make it all back because these 300 million lots that they just took out, what can they put back into the market? 300 million buys. Perfect. Is bank logic making sense for you guys?
Yes.
Perfect. Now you're going to need to be thinking like this out in the field, okay? Where are bank orders established, meaning pivot points, right? And where and why would price retrace to that position anytime in the future, okay? So now we have these 300 million buys. They obviously need to sell a little bit more. Let's say they only place on 100 million in loss, right? 100 million sell. Now what needs to happen is price skyrockets out of there. This right here is called the bounce up. It's called the bounce up or the last point of supply or support, right? Last point of supply or support. The reason for this is because banks need to essentially show a position. Oh, sorry. No. This is wrong. Whoops. This is the bounce up or the SOS. The SOS is the sign of strength. Okay. The sign of strength essentially shows this is where banks test, right? Because obviously they're not the only entities in the market. So they need to make sure that they can break out of this trading range. And with the power that they have, they can break out of this trading range. If by some reason the bank cannot break out of this trading range, you will see the banks stagger out here and then drop it back down for another test. That's because they need more liquidity, okay? So now that you have this bounce up and sign of strength, this sign of strength is going to be very, very telling, okay? You can get in on the test, which is completely fine. You can get in on the test. However, it is much safer for you to get in on the LPS, right? Last point of support or supply. The reason for that is fairly simple. You want to get in at this position or on this position because you have now established bullish structure and you want to make sure that you're only taking buys at this position because you're holding bullish structure now. This backup or sign of strength should give you a second entry. The LPS or LPSY should be your second entry. Your first entry should be after the spring on the test. Okay, it should be after the spring on the test. That's what it should be. Okay. Now, this right here is meant to take out liquidity and grab stop losses for entries for banks. This essentially is the spring grabbing energy, is the spring grabbing liquidity for the banks to shoot up and then create their expansionist move. So what is this sector? Expansion. Okay. That's essentially what accumulation looks like. Does this make sense to you guys?
Yes.
Okay. This is the same on all time frames. Yes. Yes, Andrew. This appears on all time frames. Okay. Yes, it appears on the 1 minute. Yes, it appears on the 5. Absolutely, it appears on the weekly. Okay, it appears on every single time frame because banks, because what? Because what is our first law?
Price is fractal.
Price is fractal. Since price is fractal, price must give you a sign of reversal on the lower time frames for it to express itself on the higher time frames, because the lower time frames build the higher ones. Can you go over sign of strength one more time? Absolutely. The sign of strength is essentially the phase after the test when it breaks out of the trading range. The reason why it needs to break out of the trading range is essentially because it needs to, since the banks aren't the only entity in the market, it needs to test whether or not it has enough strength to actually sell, or sorry, buy, right, in this case. It needs to test its strength and say, okay, can I actually buy? Do I have enough liquidity, or do I have enough weight? Because the Forex market is a what market? I don't know if you guys remember this. It's a weighted market, right? Which means that whoever holds the most weight is the one that decides where price will go, right? So they have to make sure whether or not they have enough liquidity to break out of this position, okay? And when they do break out of that position, then again, they mitigate their losses that they had back here as much as they possibly can. Sometimes they drop it even back down here and then shoot up from there. Okay, the sign of strength is simply an indication of saying, hey, price is very, very likely going to come back up here. A lot of times what you see the sign of strength end up being is, it's in this case, right, it's one big bullish candle that ends up with a huge wick and a small body. And what do you think ends up happening? Say it's like a small body and a large wick. This goes into volume profiling. What do you think happens here? What is this called? I'm going to use this this opportunity to show off my students. What is this called? My boys? Liquidity. What type?
Exposed liquid.
Exposed liquidity. Perfect. Perfect. It's exposed liquidity. This goes into a different topic, which I will explain on day 2, I believe. But I just want you guys to keep this in mind. So does this make sense to you guys? Do I need to go over something? Can I move on to distribution?
Yes, sir.
Yep.
Okay. Distribution is not much different, but I'm going to show it to you. Okay. Next is distribution. This is usually found after the completion of a bullish cycle. What does this mean? Essentially, all that it means is this happens after price shoots up for a while. It has its last point, it has its preliminary supply. And it starts doing this. It starts doing this essentially. That is actually kind of lopsided. Let me fix this. Let me fix it. Actually, I can use the GJ example. Let me go ahead and do this. Never mind. Just gonna go ahead and use this example on the weekly. Okay. So we can have a little bit of a live example. Let's go ahead and use the replay button, and let's go ahead and take it play by play. Okay. So we're at the end of a cycle. Correct? We're at the end of a cycle. We've already mitigated all our losses, right? Because on the way down, we mitigated losses. So now we start at a completely new cycle. What happens over here doesn't matter. because our lows have already been mitigated and our losses up top have already been mitigated. So this is a completely new cycle. This is the start of a new cycle. Okay, so all this over here doesn't matter. Doesn't matter at all. Why? Because you have just completed your cycle. Let's go ahead and make this as opaque as possible so we can focus on the next play-by-plays. And actually, let me change the color to like that so we don't get confused, okay? Now, let's go ahead and watch what happens to price. Let's keep watching for one moment. Now, this is actually a very, very good time to pause the video and speak about candle movement. Do you guys remember the first section that we were talking about, candle movement? How it starts, you know, like moving like very, very staggered? That's candle movement, and that's exactly why you should never, never, ever stare at your chart. You should let it play out, put your stop at break even if you're in profit, and you should let it play, because these candles are made to psychologically psych you out. Okay, but you don't want that to happen to you because price is going to fluctuate, you know, like very, very erratically, and you don't want that to scare you off your position. That's what banks want. That's not what you want, right? Now let's start taking it by the first, by its first place. Okay, by its first place. So right here, you could have looked at the market and you could have said, okay, I'm starting to see distribution. And you could have even gotten in right here. But let's say we're looking at its first points, right? Right here would have been its essentially its preliminary supply. You could have had it right here. It's up to debate because there's a variation of distribution, but I'm going to use it like this so we can see it as a full position. So this right here can be considered our PSY. This right here can be considered our PSY. This up here can be considered our, oh, whoops. What do you think this can be considered?
The buying climax.
Perfect. Perfect. I love that answer. Buying climax. And what do you think this is?
Automatic rally.
Automatic rally.
Automatic rally.
Well, is there a different, because I've been researching it, so is it a difference between automatic rally and automatic reaction?
Same thing, different lingo. Actually, that's the correct term, automatic reaction. But that's how Wyckoff originally named it. But it's easier to say rally. So, what's after the automatic rally?
The secondary test.
Secondary test, which would be up here. Right? You have 2 in this case, which is completely fine. Now, what is this? You guys see our trading range was established down here. Does anybody have problems with their mouse like unclicking? Because I've been having a lot of problems with that, and it's very, very, very horrible. Anyway, like that, it's very annoying. But anyway, we have our established trading range, right? And from there, what do we want to have? This right here is actually called an upthrust. or a UT. Okay, and this UT is followed by a UTAD, or an upthrust after distribution. And the reason why the upthrust after distribution happens is because pushing price lower is kind of significantly harder sometimes, because of the fact that it has to, you know, reverse trend almost completely, right? It has to kind of grind it to a halt and then try to push price lower. A lot of people on these positions, they have a lot more liquidity to fight against, right? And since they have a lot more liquidity to fight against, they need to collect a little bit more liquidity. What happens? Bearish structure is broken here. Since bearish structure is broken here, you can expect a further sell, right? Now, what do you call this?
Order block.
Not precisely. What is the next phase after the upthrust or the shakeout?
Sign of weakness.
UTAD, then test,
The test.
then
Test.
LPSY.
Oh yeah.
Test, right? And whoever just said order block, you are correct, but not yet. And I'll explain to you why. This is a test, right? Because whoever just said order block, you see it actually went back up to the UTAD's order block, and then it dipped off. See that? And I'll explain that later. Yeah, you were right. You were right, but just not in that context. So let's keep watching. And let's see if we can identify the sign of weakness. Can we identify the sign of weakness?
The wick.
This
That
right
wick.
here was the sign of weakness.
Expose
What did I
liquidity.
just tell you guys about signs of weaknesses being large wicks with small bodies? Did I not just say that?
Yep.
You
Yeah.
did.
It's called SO, or sign of weakness. This sign of weakness is also known as breaking the ice. Breaking the ice, okay? Why? Because essentially, let's pretend, you know, that price is a person. It just jumped on, you know, it just jumped on the ice and it broke it, right? So it broke the ice. Now, what is this called?
Expose liquidity.
No, not that. I'm talking about this. Talking about this.
The last point of supply.
LPSY.
Perfect.
Yeah.
LPSY, last point of supply. Right, and that last point of supply essentially helps you gather enough information to say, hey, this bullish structure has come to an end and bearish structure has now begun, right? Even though this could have been your second entry, honestly. Why? Because you already had a test. This could have been your third entry because your stop loss would have never got hit up here, right? Right at this position. So you could have entered again right here. You would have had 1, 2, 3 entries, 4 entries if you were paying attention. And what ends up happening? Let's go ahead and press play. You get a 5th entry. And price ends up dumping off the map. Perfection.
Wow.
Now, from here to here, how many pips do you think that was just going off the weekly chart? It was almost 2,000 pips.
5,000.
Almost 2,000 pips. Going off of just weekly schematics, you could have easily made 2,000 pips times 1, 2, 3, 4, 5. 5 times. And then let's say you would have gone off previous structure right here, and you would have said, if this is a true distribution schematic, this should also respect, right? You would have caught another entry and would have gone a total of, can't even use the ruler. Mouse is all out of whack. It would have gone a total of another 2,000 pips. Perfect. All based off of these schematics. Now, am I saying that these schematics are all you need? Absolutely not. Test. Okay. Could you re-explain distribution right quick? Absolutely, Andrew. Distribution essentially is the sister of accumulation, and it essentially means to sell, right? And this distribution essentially, it gathers liquidity a little bit differently because it doesn't just have one, spike down, or it doesn't just have one spring. Usually what ends up happening is there is the upthrust and then the upthrust after distribution to mitigate itself. Now, one thing that's very, very important to note about distribution is the fact that distribution ends up mitigating its own loss after the upthrust after distribution, because look how price kind of reacts to itself, and it goes boom, boom, right? And it ends up returning to previous structure and then falling. Okay, when it returns to that previous structure and then falling, it essentially establishes bearish structure. Okay, and then from there you could have easily, once it broke below. So a lot of people ask me, how can you even identify a test before it actually happens? How do I know that you're not just looking at this from hindsight? Well, easy, because it actually broke this structure. It broke this right here, right? It didn't hold its position. You see right here, it actually held its highs. Sorry, its lows. It held its lows. Here, it no longer did. So I know that right here, this order block right there is valid, right? And now we're going into top down and order blocks, which was our last couple things, right? It was top down and order blocks, right? So let's go ahead and get into those. Okay, now the test happens, and then the last point of supply happens. The last point of supply can be the safer trader's entry, or you could just go ahead and enter off that position completely fine. Now you're entering this position, and you can enter right here as well again, because you're aiming for this exposed liquidity. And that's how you would have caught this entry right there, because you know that this exposed liquidity is right here, this breaking the ice, and it has to come back down into the water, right? It has to come back down into the broken ice. So what happens? It comes back down. You could have cut your entry based off of previous structure, and boom, you would have had your entry, right? Perfect. Does everybody understand distribution?
Yeah, I understand it, but I just had a question. So this is showing it on the weekly time frame. So how would you hop in a trade this way? If you're looking at it on the weekly. So each candle is a week, right?
Yeah, each candle is a week. So perfect. Yeah, perfect question. This actually goes into top down, and it goes into order blocks, right? It goes into order blocks. So right here, every single time that I start looking at a trade, I want to look at the weekly. The reason why I go to the weekly down, right, is because on the weekly it shows larger time frame structure, meaning that I can tell whether or not there's a schematic here. I can tell whether or not there is something of interest in that position, and I can also tell whether or not there is previous structure that I should be targeting. Now in this position, right, I would be looking to enter right here. Why? Because let's say price was like right around this area, right? And I would have, let's actually replay this. And actually, yeah, we're around previous area, and again, it reacts off of this. You see, it reacted off of previous structure, and you can expect a take out of this liquidity. So let's replay it back to around up here. And let's go ahead and let's get rid of all these. Okay, and then let's say, perfect. We have our upthrust after distribution. However, we don't know that it is, but we also do know that its lows have been holding, right? So low, low, low right here. And now we have this previous low. However, this previous low is broken. So we have this right here. So now we have an area of interest because this low was broken. Since this low was broken, now we can expect and say, okay, how are we going to go ahead and take this trade? Well, easy. We're going to go into low, we're going to look at this right here, and we're going to say something known as an order block. Who can tell me what an order block essentially is? And if you don't know, that's completely fine. Let's go over it. Essentially, an order block is the candle before the last movement in the opposite direction. And I'll explain it here in 1 second. Let's say we're looking for a bearish order block. What you need to be looking for is you need to be looking for the last bullish candle before a reversal. Okay, so let's say price is coming up here, and now price has made, whoops, that is horrible. That is not even a straight line. Price ends up doing something like this. Right, and then we have its bearish candle, which ends up, matching it, and then ends up going this way. Okay, now price ends up pushing down. All right, price ends up pushing down. Let's say we have a couple wicks right here, whatever, right? Price ends up pushing down. Now price eventually has to return up here because, as we saw on the GJ structure, right? The low was held, the low was held, the low was held, the low was held, the low was broken. Since the low is now broken, we know that this order block is now valid because it's essentially showing a reversal of structure, right? Now go into spotting these in 1 second once we get the anatomy of an order block correct, okay? The anatomy of an order block is extremely important because you have essentially 3 positions that you want to take into consideration. And I'm going to draw the this candle. This is going to be this candle, right? This is the exact same thing. Okay. There's going to be 3 positions that you want to concern yourself with. And those 3 are essentially the 50% of the candle. Okay, the 50%, and let me actually write this down. 50%. Whatever. And then you're going to have the open. Okay, and you're also going to have the end of the candle or the wick. Okay, and the reason you're going to have these is because these 3 positions are going to be where your order is essentially going to be placed. What do I mean by that? Usually your order, which ends up being, the 50%, your optimal trade entry is going to be the 50%. So that's usually where you can set your sell limit, your buy limit, right? That's where you can usually place your limits and expect price to go to for a most profitable entry, right? Order blocks will usually be retested around the 50%. Sometimes they get retested by the open, which is completely fine. You can still find a low drawdown entry based on order blocks if you go ahead and enter at the open. Now you can have 2 sell limits. You can have 2 sell limits. One, you can place it at the entry. Right? Let's actually place it down here. One, you can have your entry at the open, and the other one you can have an entry at the 50%. Now all of your stop losses will be right here. Because if it breaks the structure, then that means it's not going to hold it. There's no reason to have a 70, 50 pip stop loss. This usually at max will be like 25 pips at max. At minimum, I've seen it as small as 9 pips. I've seen it as small as 6 pips. But from these order blocks is usually where you want to catch your price entry, right? So from these, you grab this 50% and then you place it on here. And this is going to be your entry. Now your take profit is going to be your equal low, but I'm going to go ahead and show you. Does everybody understand the anatomy of the order block? Can I go back to the example now?
Yes.
Yeah.
Whoever just raised their hand can go ahead and speak. Or type, whatever they would like to do.
So basically, it's just telling you what point of the candle to place your order, whether it's going to be a buy or a sell.
Yes. It
Okay,
essentially
yeah.
tells you where price is going to, where the banks are going to place their orders, as well as where as well as where you yourself can follow in their footsteps and say, okay, I know that price is going to be returning to this position, so I can go ahead and put my limits right here and my limits right here and my stop loss back there. Right now, let me go back and show you in this example what ends up happening. Right here, where is our order block? Order block's right here. So what would have your risk to reward look like? Whoops. Your risk to reward would have been down here. Well, your stop loss would have been back here. And then your take profit would have been at equal lows, which would have been all the way down here, right? But then what is your entry going to look like? Your entry is going to look like this, either at the open or at the 50%. Here you can have two entries. You can put it a little bit in front of the open, and you can put another one right at the 50%. Perfect. So now you have your two entries. Now let's observe price and see what happens. Your first entry was wicked. Your first entry was wicked, and now your limit is active. So in this case, it hit the open, and it decided it couldn't go any further. It hit the open, it respected bearish structure, and now you have just caught the test with a 5 R&R, right? Not just with that, if you would have gone into lower time frames, you could have seen that a lot more explosively. Let's go on, let's go on the 3-minute, because I love, oh, whoops, damn, it doesn't have historical data. Tough. Okay, let's go back and let's say we look at it on the hour or something like that. Let's see if we can actually look at it on the hour. Let's replay it back here. And let's see if we can hit it up on the hour. Please? Yes, awesome. Now, what does this look like? What does this look like?
Distribution.
Distribution. Perfect. On the hour, it looks like distribution. If on the hour it looks like distribution, what could you have gotten here?
So
You could have gotten a really, really good sell. Now, instead of having this giant risk reward, now that you had this area of interest marked up because you know that you had a weekly order block there, you could have zoomed into lower time frames and you could have said, well, I'm now currently at the open of the weekly order block. I'm going to go ahead and watch structure and try to see whether or not price is actually going to stop there or whether or not it's just going to, continue going up higher to the 50% of the order block. What do you end up seeing? You end up seeing a perfect distribution schematic, right? You end up establishing your trading range, and actually it doesn't have an upthrust in this case, but this is a variation of distribution where the upthrust doesn't actually happen. It just stays within its trading range and then establishes bearish structure, which is right here, right? It establishes bearish structure, and again, here's your hourly order block. Your hourly order block, look at this. It hit, oh, whoops, let me not put it that opaque. Let me put it like this, and then let me switch the color. There we go. Perfect. Okay. So now, what do you see right here? You could have caught this position by looking at this hourly order block, and you could have said, perfect, let me put my first entry right at the open of the order block, my stop loss at the top of these wicks, or at the top of this wick, because if it clears that, then it's not going to be there. You have a 17 pip entry. Now you take your fib, then you fib it like this, right? A lot of people don't like using fib. This is the only thing I will use that is retail, because I like it for targeting. Okay, how do I know where to place my take profit? Because of these fib extensions. Now, if you guys want these fib extensions, I'll give them to you now, so you guys can put them into your own trading view or into your own MT4. I have no idea how to put them onto your MT4. I only use trading view, but you guys can go ahead and take them. Screenshot them, please, so we can move on. Everybody got them?
No, wait 1 second. Okay, now I have it.
Enrique asks, how many different variations of Wyckoff schematics are there? Between accumulation, in accumulation, there's usually a general 4. And then in distribution, there's also a general, like 3 or 4-ish. I think there's 3 in distribution, yeah. So now that everybody has them, let's move on and let me explain to you how I use it. To me, the 1 usually is always the stop loss, okay? The 1.1 is kind of that last swing point that if it stays beneath the 1.1, I can consider a re-entry. But apart from that, the 1 is the stop loss. My kill zone is not some magic number being, the 61.8, between the 50 and the 61.8. It's not a magic number. For me, the take profit ends up being, or sorry, the kill zone ends up being between the 79 and the 886. Between the 79 and the 886. And the reason for this is very simple. It's not because of a magic number. It really ends up being that statistically, markets prefer extremes. They don't like retracing only halfway. They don't like retracing only a little bit. They don't like retracing that way. They love retracing to extremes. So essentially, I'm going to look for my entry around the 79 or the 886. That's what I'm trying to do, because statistically that has the best chance of actually landing, right? The 705 is usually where I place my alert, or where I'm like, okay, well, price has reached the 705. Let me go to lower time frames, because what's our number 1 rule?
Price is fractal.
Price is fractal. So if price is going to reverse at this position, I'm sorry that we can't go on lower time frames to get you guys a good example, but in lower time frames, you see a distribution schematic on the 3-minute or on the 1-minute, and you could have caught that as a sniper entry with a 4-pip stop. And I will show you guys how to do this on part 2, because that requires me going back and finding a good example. Actually, I have a good example. I'll show it to you guys in a little bit. So again, how I use my fib. Does everybody here know how to use their fib? Or at least know how to place it? Yes, let me make sure that everybody knows how to place it. And if you don't know how to place it, let me go ahead and give you a quick example, okay? Let's say you have a swing high and a swing low. Like say you have it like this, right? And then price goes below and then does this, right? This is known as your swing high, and this is known as your swing low, okay? So if you are going in a downtrend, you place your fib from high to low. On the contrary, if you're in an uptrend, you place your fib from low to high. Okay, so in this case, let's say we're going from high to low, right? We're in a downtrend. We would place our fib up here, and then end it right at the bottom there. And we're looking for retracement to come back up to around the 88.6, 79, and then from there drop off and keep going, because the market prefers extremes, right? Does this make sense to everybody? Okay. Now let's say you're going in a different direction. Let's say you're going in a buy, right? Let's say you're going into a buy, and now you're going like this, right, up into your high. So you'd place your fib like this, right? And you want price to come back down to your 88.679 and then bounce off. Okay, that is how you place your fib. in the most simple terms possible, without doing another class on just fibs. Okay. So now going off of this explanation, how I use the extensions on my fib. How I use my extensions on my fib is extremely simple. I simply have these extended fib levels so that people can tell where where I'm aiming for price to go in an extremely consistent manner. Why is that? Because price will usually fill in these extensions. Statistically, it's where price is predicted to go, right? So using numbers to our advantage, I use these extensions to essentially say, hey, I know that price will probably go further, and therefore I use them as extended take profits. So essentially, each one of these lines is going to be another take profit for me. That's where I secure another piece of profit. Or whenever the move ends or starts retracing, that's where I close out, right? So in this case, you just went off of weekly structure, right? That was an amazing question, whoever asked it. Amazing question. Because you went back and you looked at weekly structure and you saw that the low was broken, right? And when it started retracing, you went back and you said, okay, let me find the open of the weekly order block. You found the open of the weekly order block, and then you started looking at lower time frame structure, because what's our number one rule? Price is fractal. So what are you going to do? You're going to look at lower time frames, and if you would have been on the lower time frames, if you saw this on lower time frames, I promise you there's going to be a beautiful distribution schematic right there. And you could have dropped this from 17 pips to 3 pips to 4 pips. Now I'm about to blow your mind with the next example that I give, okay? So now that we have those up, does everybody understand how price correlates with your order blocks, as well as how price is fractal, meaning that how price actually went from a higher time frame that you got, your higher time frame structure, you go down and then you start looking at your lower time frame structure, and from there you start looking for your entry on these lower time frames, and you end up catching a sniper based off of higher time frame structure. Now, a lot of people like trading HFX, right? Since a lot of people like trading HFX, what do you guys think you could do on HFX? What if you went off of higher time frame structure on HFX, and then you went down to the 3-minute, the 5-minute, and you ended up opening multiple contracts because you know this is where price is going to go because of your 1 hour, because of your 2 hour, because of your weekly structure? You can make a ton of money off of HFX just using this, just using higher time frame structure. Okay? Does everybody understand this? Let me get some activity in the chat, so I at least know you guys understand this in a proficient way, so I can continue on to my next example. And if you need me to go over something again, please, I'd be more than happy to.
James, can I ask a question?
Go ahead.
So if you find, for example, distribution on the weekly, you're saying when you go down to the lower time frames, you're not looking for distribution, you're looking for the order block, correct? So of course, it's not going to be the distribution on there.
Well, yeah, so you're looking for both, essentially, right? You're looking for the distribution as a schematic, right? You're looking for it as a whole. However, distribution itself isn't going to give you an entry. What you need to look for is your entry, and that's where the order block comes in handy, because the order block is essentially a telltale sign of an entry, right? It's
Gotcha.
usually a very, very telltale sign of an entry happening, right? Did that answer your question?
Yes, sir. Thank you.
Okay. What about everybody else? Does that make sense to everyone else? Yes? Let me check the chat here. It's actually going off. Yep. Okay, yes, sir. All right, cool. Now, do you guys see what actually ended up happening to price based off of this position? What ended up happening? You ended up hitting 275 pips on a 17 pip stop loss. Now you tell me, when have you ever seen somebody do that? When have you ever seen a trader do that? I very, very, very much think that very, very few traders know how to do this. And the ones that do are very good. When I was taught how to do this, my mind was blown. But the guy that taught me, he's a 7-figure earner. And you can't, the only reason I know him is because he was a family friend. You wouldn't have been able to reach him otherwise. Why? Because he wakes up in New York, right, in New York session. He trades, and then he goes and handles his other business. He's not on Instagram. He's just there trading because he knows how to, right? So when you see people trade like this, that's how you know that they know their stuff. Because risk to reward is king in the markets. And I want you guys to write that down. Risk to reward is king in the markets. Why? Because what would you do if you had a 3-pip stop and you know that and you had like a 300 pip TP? What lot would you place?
At least one or more.
Standard.
A standard, okay. A standard. What about everybody else? What are you guys going to tell me?
You would risk everything because you know you would get it like back.
Right, a lot.
Yeah, yeah. You're going to end up. And now how are you now? Imagine your account growth with this.
Right.
Do you guys see what I mean?
Yeah.
Do you guys see how this is a completely different style of trading? No more 40 pip TPs. No more 40 pip stop losses for a 20 pip TP. No more negative R&R. That's what you don't want, right? So if you see a trade being sent out and you see that it has a 1-to-1 risk reward or a 1-to-2 risk reward, that's not really good, because you're risking almost the exact same, and at that point you're just flipping a coin. Right? If somebody was very, very confident about their trade, they should be able to have very good entries, right? That's the telltale sign of a good trader. Good entries, right?
Wow.
Does that make sense? Now, let me go ahead and blow your mind and show you guys what ended up actually happening with this position. And after that, right here, you see a little bit of accumulation. So you could have closed partials, or you could have closed completely. It would have been your choice. Your take profit got hit, but at the same time, you went back and you hit the previous order block. It wicked the previous order block, and then you could have had another entry. Look at this. Wicked your previous order block right at the open. It actually probably missed by spread. Let me make sure. Yeah, it would have missed by spread. You're that accurate that you are now missing by spread. You are so accurate now that you're missing by spread. Imagine that. Red at your 886, you stop loss at the 1. A 22 pip stop for a TP that I don't know if it hit or not, but let's go ahead and check. It would have. I mean, that would have been your last TP, obviously, but still want to go see if it hits that 663 pip take profit. Let's go ahead and check. So it actually ended up dropping quite a bit. Boom, look at that. Here you see a little bit of accumulation, so you can expect a little bit of an uptrend, and then it continues going down. And it ends that cycle with, let's say, let's see, so it would have actually missed by spread, but let's say we would have, tapped in a little bit more and we would have made a 30 pip entry. You would have actually ended up having, if you would have gotten in on that position, a complete total of almost 556 pips off a 28 pip stop. Kind of insane, right? When have you ever seen this type of R&R? Well, it's not just a one-time thing. It's actually a multiple-time thing. It's actually a multiple-time thing. People, this has, happened many, many times. And Andrew just made a very, very, very good, a good point. 1 win equals 10 losses. with this type of R&R, Andrew, one win equals 100 losses, right? Because of the amount of R&R that you actually have, right? For me, managing, say, a 9,000 account, a 7,000 account, and a 25,000 account, what lot do you think I'm going to play? I'm going to place a 10, right? Because even at that stop loss, a 10 isn't that big of a deal, right? It isn't that big of a deal because of your R&R. Now, let's go ahead and show you guys another example so you guys don't think I'm just some guy, you know, looking back and hindsighting things. So let's go to the, where was it? I actually caught Euro USD earlier this week. Or not this week, this right here. I caught it right here. Why? Because we had a liquidity raid, which you're going to you know, be taught later, but you essentially had a liquidity raid down here. Now let's go ahead and try to look at the replay at this position, right? And you have this liquidity rate right there, and then let's say we go ahead and we drop to the 10-minute. Let's say we go ahead and we drop to the 10-minute, right? And this 10-minute is going to end up being being our position that we end up looking for. Now, we know that at this point we're looking for an entry. Why? Because we had a topside liquidity rate. You're going to understand that once you've gone to bootcamp day 2, 3, and 4. Now up here, let's go ahead and check and see whether or not, so price never gave us an entry, perfect. Price doesn't give us an entry yet, no entry yet, no entry yet. And right here, what do we see? Let's go back test this. And let's go to our 3-minute. What's this look like? This right here. Bullish structure. It actually is distribution.
Distribution.
Right? Why? Because this bullish structure turned bearish, right? Sign of weakness right here. As I said, in the field and in the textbook are going to look two different things, but that's why Wyckoff variations exist, right? What you really, really want to be looking for is you want to be looking for your previous low to get murdered, right? Right here, it gets murdered. And then from here, it goes back up to a previous order block. Right there, perfect, boom. You would have had 2 entries right there. So what would you have had? Your previous order block would have been right there, 50%. Stop loss behind this high. You could have even had this behind this wick, 3-pip stop. And again, you can fib it if you'd like to give you those, you know, those extra confirmations. Boom. And now you move your take profit all the way down. A 61-pip take profit, even though you could have gone for more. And then from there, you would have risked 3 pips or 3.9 pips for 61 pips, which ends up being a 15 risk to reward ratio. What ends up happening? You get another retest and bam, your take profit gets hit. What lot would you have placed in this position? You would have, I mean, I'm willing to bet you would have placed, you know, your whole house.
Right.
Why?
So, I'm sorry.
Well, okay, I was about to answer Brianna's question. What do you, when you say miss by spread, what does that mean? Essentially, that means that you guys know the difference between the bid and the ask, right? Like the 2 little lines on your MetaTrader.
Yeah.
Yeah, so that's spread, right? So if price doesn't cover it all the way, the limit doesn't activate. So sometimes with this strategy, you get so accurate that you have to end up setting alerts on TradingView to actually show you when price is getting close to your entry, because it gets to a certain point where price gets so close to your entry but actually doesn't hit it, that the spread of your broker actually doesn't hit it all the way. It just barely covers it by like the top line, or it stays in the middle of the spread and then it just drops off. That's what I mean by missing by spread. That's personally why I like Eagle FX as my broker. And I sent that link out to you guys in the wealth chat beforehand. So do you guys end up seeing why this strategy is so full of potential? Because once you see these bottoms get murdered, right, and then you see the sign of weakness and then this retest, this ends up being a very, very good entry, right? And this didn't just happen here. This happened in so many other places. And let me show you. Let's go to Euro JPY. Let's go to Euro USD and I'll show you. Actually, let's focus on Euro JPY for a second. Right here. Oh, right here. Actually, I still have it marked. Perfect. Let's go on 4-hour structure. Let's see what's going on 4-hour structure. At 4-hour structure, we see those highs, but what does this look like? What does this look like from here to here?
Distribution.
Distribution. Perfect. Well said. Distribution. So what are we looking for? It tapped an inefficiency, right, and then came back down. We have open liquidity here, which to people that are a little bit more advanced, we could possibly come back up and tap this daily order block and then fall, right? However, we're wondering off of this position, right? Because we said, okay, well, it's going up. Now it's starting to retrace. Now it's so right here, when this candle ended up shooting up, we said, okay, we have to start looking for a lower time frame entry. So what am I looking for? I'm looking on the 10-minute, I'm looking on the 5-minute, I'm looking on the 3-minute. I like the 3-minute. So what do I end up doing on the 3-minute? I end up looking for a distribution schematic. And what do I find? The low gets what? The low gets murdered. And what ends up happening? This new low, right, ends up getting murdered, ends up murdering the last one. And then boom, we ended up shooting up to our previous what?
High.
Order block.
Order block, yeah.
Right, our previous order block. In this position, we had our entry at the 50%. It went a total of 0.6 pips into drawdown. And it was a total of a 3.4 pip stop off of this low break, right? Breaking this low and then continuing up, retracing, hitting this low and then continuing down. And it ended up being a 3 pip risk for a 100 pip move. Why? Because based off of higher time frame structure, we see that this area of interest is good, right? It is good to actually move into. And then on lower time frames, because price is fractal, we want to see price express itself on the lower time frames. The low gets broken, meaning our sign of weakness was on the way. Sign of weakness leads into the last point of supply. The last point of supply tests the test, and we put our stop loss above the high, because if this is true distribution, then that high has no reason to be broken. And thus, we risk 3 pips for 100 pips with a 29.5 risk to reward ratio, and you just flipped your account 3 times because you placed a high lot.
Wow.
Now let's go look at Euro USD. Let's see if I still have that one marked. I should. I'm pretty sure I should. And here in a little bit, we're going to get into new concepts for you guys. Okay, so right here, what did I see? I saw a distribution schematic, right? So what am I going to look for? Now, I saw this upthrust at that point, right? And I said, oh, then I should probably be looking for lower time frame entries. However, for you more experienced people, you know that this is now exposed liquidity, which we have to go capture, which is doing right now. Perfect, right? It has to come up and capture it and then come back down. It's probably going to hit around here somewhere and then probably fall off. So what do we end up seeing here? Right there, we could have ended up replaying this. Actually, let's not replay it. Let's just look at it because replaying is annoying. So let's go to the 3-minute and then let's go back and look at our position. Where is our position? Should be somewhere up here. I should look back and try to find it. This is why replaying is very annoying, but it's very, very useful. Okay. Fine, let me replay it just a little bit. What do we see here? Tell me now, you guys, what do we see here?
Distribution
Distribution.
Doesn't it blow your mind?
on a lower time frame.
Because price is what?
Fractal.
Oh,
Wow.
wow, right? Wow. Wow is very much correct. And what happens? Your low gets murdered. Boom. Now what are you looking for? You're looking for the possible retrace. So you could have fibbed it. Perfect. Short position. You ended up placing it at the 50%, so right around the 79. Risk at the 1, right stop loss at the 1, because it's a true upthrust. And then from there, your stop loss there, oh sorry, your take profit at the 50 pips, or you could have let it just keep dropping, right? Which would have been a previous structure. So right around this area as well, you could have let it gone down here, which would have been completely fine because that was previous structure, right? And then let's see what happens. I think you end up getting another entry or not. Boom. There's your take profit hit, and you would have just made yourself birthday money because you know how to trade. And now let me ask you guys a very, very important question that will probably piss off your mentor. When did you ever see a trend line, a supply and demand zone, a support and resistance zone, or a double top, double bottom? When?
Didn't.
Never, I think.
Never saw one.
So when your mentor tells you, oh, sell because it's a double top, what are you going to say?
Not what I'm looking for.
You're going to
I
say,
don't know what that
no.
is.
You're going to say, I have no idea what that is. I'm not on your level, right? So what are you going to do? You're going to risk 3 pips for a total of, let's say, how much you could have won. At 93 pips, that would have been your maximum profit, right? 93 pips. And you would have hit it. You would have hit it perfectly at a 3.7 pip risk. Boom. All the way down. Don't be a popular trader. Perfect. And you're going to get to that on day 4, which is how to trade sentiment. But you guys see how this works? Now, there is one more thing that I need to go over with you guys, and that is how to trade your schedule as well as the time zones. Okay, and after that, we can go ahead and leave it because this class has gone on for a while. But this is how these boot camps are structured. This is how my mentorship works. I try to make sure that all of you understand these positions before you actually get into trying to get into this. Because even though this may seem simple, it's not. There were many, many, many other factors that went into this before I actually decided to even look at the trade. Right. So first off, let's go over the 3. Actually, before we do that, does anybody have questions?
No.
I think we're good.
So, okay, let's go ahead and look at our next points. Can everybody see the whiteboard?
Yes.
So now, do you guys remember how I told you guys how time and price correlate?
Mm-hmm.
So there's one span between, you know, who can tell me when does the Forex day start? And it's a block of 1 hour.
1700 candle.
1700. I'm not sure of the actual GMT time, but what is this called? It's a break in the market.
Oh.
Broker hour. This is essentially 00 GMT, right? And broker hour is essentially the time where all banks are closed, right? And there's like the recess, right, where banks kind of switch. And this is where Asia sessions start. Asia session is split between two different sessions. It's split between Sydney and it's split between Tokyo. Okay, I don't really even remember the middle of those times because I don't really care. I consider them Asia, and I don't really particularly care what side of Asia it's at. They essentially move the exact same. So essentially, let's go ahead and let's say that from 00, which I'm going to put it on EST time so you guys can understand this a little bit more. This is around 5 p.m. EST, 5 to 6 p.m. Oh, 5 to 5, not 5 to 6 p.m. EST. Okay, that's broker hour. Now from here on lower, right, here we're going to have Asia session. And Asia session usually takes, this is Asia. An Asia session usually takes from about 6 p.m. Eastern to around 3 a.m. Eastern. Okay. Now each session will have a kill zone, meaning that this is where volume usually starts, right? This is where volume usually begins. This is where the movement starts happening, or the setup for London usually starts happening. And the kill zone for Asia, it actually has two. So it has the 8:30 EST to 10 p.m. EST. Usually, if institutionally sponsored candles move, they usually move during this time, statistically. This is kill zone 1, and then kill zone 2 ends up being from 2 a.m. EST to 3:30 a.m. EST, although this crosses over into London, but either way, right? These are the two kill zones that you guys want to be paying attention to. These are the two kill zones. Whoops. These are the two kill zones, okay? Next, you will have a volume profile. A volume profile essentially says how much volume actually passes through Asia session. And how much volume actually passes through Asia session is very little. It's a low volume session. So if there's low volume in a session, how would you guys use low volume to your advantage? Meaning that moves aren't really happening all that much.
Hold a trade longer, maybe.
Hold a trade longer. What if you ended up marking up your charts during this time?
Right.
HFX? Well, not really. I would prefer higher volume for HFX. But what if you marked up your time, marked up your charts during this time? What if you looked at, from your top-down trades and you ended up looking for lower time frame trades and you ended up putting your limits? You ended up placing your limits so that you don't have to be awake for London. You know, a lot of people lose a lot of sleep over London, but it's not needed. You don't need to. Now, this last section, oh, actually, one more thing that we're missing. We are missing the pairs that will move a lot during this time frame. What pairs do you guys think will move a lot during this time frame?
JPY.
JPY.
Right. So
JPY, USD, maybe.
Why would USD move?
It moves the most, right? Out of all the currencies.
Well, USD, the banks aren't even open.
Maybe GBP.
Nope, banks aren't open yet. JPY, AUD, and NZD. Right. You also have a couple exotics like Singapore. You have another couple exotics over there, but those usually don't, the ruble, right? But you don't necessarily need those. So you have the JPY, the AUD, and the NZD. Those usually end up moving a lot during these trades, right? So usually when you're marking up, you say GBP AUD, GBP AUD, GBP NZD. These end up moving during this time. GBP JPY usually doesn't move until London because JPY is so weak. But it ends up, some other JPY pairs like CHF JPY may end up moving during this time. Okay, so now let's look at London. The next position is obviously going to be London, right? So let's mark this up with a purple color, whatever color, right? So now we have London session. A lot of people end up despising London session because they don't know how to trade it. London session is not my favorite, but it's pretty cool. It ends up setting up for my favorite session. Let's go back. And now let's say this goes from 3:30 to around, when does it actually end? I think 8 a.m. EST. I think that's when it ends. Right? And this actually ends up crossing over with New York, and I'll go into that in 1 second. But this is kind of like the true London, right? This is where the London session actually ends up happening. Now the kill zones are from around they're from around 4:30 to around 6. Usually whenever you see moves on London session, you will usually see it right around this position. Okay, right around then. Next up, what pairs do you guys think end up moving during this time? What other pairs would move here?
Wouldn't USD move technically, since it would cross over at some point?
At some point, yeah. Right, that's generally about it. These are usually the pairs that have most volatility during that time. Now, if Asia and London, would be very, very close to each other, then you can start making pairs, right? GBP AUD, GBP JPY, GBP NZD, CHF NZD, NZD CHF, sorry, CHF AUD CHF, right? CHF JPY, USD JPY sometimes moves during this time, right? So you have these pairs that are moving here. Next, let's go ahead and put the best color, red. Let's go ahead and put it on New York session. This to me is my favorite session, and it is what professionals usually trade because it has, 1, the most volume, and 2, it is also the most convenient, and London to New York session reversals are a very, very, very big thing. So New York session, what ends up happening? This starts at around, for me personally, New York session starts at 7:30. Does it actually? No. But, well, actually starts at 7 o'clock. But for me, 7 o'clock a.m. Eastern is when I wake up, I go to my computer, and I start trading. 7 in the morning. And then from there, it lasts until 5, right? It's usually the whole day. But to me, this is not a textbook definition of the time zones. This is my definition of the time zone, and this is how I understand them. So 5 o'clock Eastern. However, by the time 12-ish hits, I am not at my computer anymore. Okay, so I'm done by 12. By 12, I don't touch the stock market. I don't touch the Forex market. I don't touch my phone. I go and I live my life. Okay, because I also have a life. And that's what you all should be doing too. You should not be trading every session. You should not be glued to your phone. Discipline. Be disciplined. You have to have almost a militaristic approach to the market. You can't be all lazy, all goofy, trying to trade whatever and being like, oh my goodness, I hit this take profit. Ha 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 ha. You have to have a militaristic approach to the market. You have to be disciplined. Okay. So if you have time, a lot of people, they work during certain hours. One of my students, Ladarian, he works offshore. He literally works in oil rigs, and he's telling me, hey, Hex, can you help me out, please? Like I can't attend. Can you please record it for me? I said, absolutely. So when is he gonna trade? if he's working from like from 6 p.m. to 6 a.m. He could trade New York. Perfect. He could trade New York. Stay up for a couple more hours and trade New York, then go back to sleep. By 12, he's done. And then he still has another, maybe by 11, by 10, he's done. And then he has another 8 hours to sleep. Perfect. That's a perfect session for him. Let me fill out the rest of this information really quickly. So the kill zone is from around, again, the kill zone is from 7 to around 12 Eastern. Right? And this is PM Eastern, right? And then the pairs that move are USD, CAD, MXN, and usually a lot of commodities move during this time. So first of all, indices, commodities. So if you wanted to really add it, you could, add Euro stocks 50. You could add, I think that's it, right, for these. And then you could have also had, up here, you could have a Nikkei 225, AUD, Aussie 200, right? Those are the indices that move during this time. And usually because AUD has so much influence over gold, gold ends up moving a lot during this time. In this position, gold also moves here. Silver, a lot of natural gas, a lot of US oil. And if you wanted to be a little bit more specific, you could put Brent oil here. Right, perfect. Now you have a comprehensive list of what moves when and the kill zones. Take a picture of this. Take a picture of this and please screenshot it and send it to the chat if you could, TJ, or anybody else. If you guys could take a screenshot of this and send it to the chat, that'd be amazing. Perfect. Now, here is when one of the most important things about trading comes into play. Right? Yeah, you place one trade, backtest a few, then go to sleep. Perfect. But you're already way ahead than most people because you're working, you're living your life, and you're trading. A professional trader does not stay in front of their computer all the time. You can ask any of my friends. I'm usually not looking at my phone. Why? Because I'm very confident in the way that I trade, and because you should have confidence no matter what you do. Okay, so now let's go ahead and format your own schedule based off of these, right? Let's say that you, for example, let's go ahead, is TJ still here? Let's go ahead and put a schedule around TJ. I don't know if he's here still. I don't think he is. No, he's probably on his flight. He's probably on a flight. Let's see. Daniela, can you speak?
Yeah.
Yeah. Let's go ahead and format a schedule around you. Okay. So let's say around you, when do you usually wake up?
I wake up around 8.
Around 8. Okay, perfect. When do you have work? Do you have school?
I have work in the mornings.
You work in the mornings? Okay, so usually you wake up and go to work.
Well, I wake up and then I have work around 11 till 3.
11 till 3. Perfect. Okay. If you have worked around 11 till 3, what if you woke up an hour before and you traded New York session?
Okay.
And you could have all the volatility of New York session. And actually, let me add one more thing. So this is high volatility, high volume, and this is also high volume. Okay. So you can have the volatility of New York session. You are asleep during London session. So whatever happens during London session, you don't care. You care about what happens to New York session, right? That's what you care about. So essentially, you don't have to worry about London. You can let London go because you wake up for New York and you can make this your trading schedule. You can say, okay, I mark up my charts from 8:30 to around 9, and then from 9 to say 11 or whatever, you're doing whatever you want. Then you go to sleep. You wake up at 7 a.m., right? And then at 7 a.m., 7:30 a.m., you're trading, and then you end by 10:30. By 10:30, you're at your job. By 11, you're at your job, and you're working from 11 to 3. You come back home, you check your trades, you adapt your plan, and then you go back home. You have a couple hours to chill out, right, from 3 to around 8:30 again, and then you repeat the process. How many hours of trading is your day? Not many.
No,
It's
not
not
many.
many. You shouldn't be staring at your chart. If you guys are trying to build your team, build your team. Go for it. If you guys are trying to learn more and tap in with me, have a one-on-one. This is my full-time job.
Yeah, I would like for this to become my full-time job too.
But for you to have a full-time job, you have to have a schedule. And this is exactly what I just made for you. What I just made for you is technically your professional schedule. Okay? Because you wake up at 7, you trade from 7 to 10:30, from 11 to 3, you go to work, and then from 3 to 8:30, you're free. You can hang out with your friends, you can do whatever you want, and hell, you don't even have to mark up Asia session. You can just straight up jump cold turkey into New York. That's what the person who taught me did. Right? That's exactly what he used to do. He used to just be like, I don't even trade Asia session anymore. I don't even look at it. I just go straight to New York. Asia session sets up London. I just look at New York and look what happened in London and do the opposite. And it worked for him. That's exactly what he did, and that's what he taught me. That's how he taught me. Right? So now I give you your own professional plan. You are trading from 7. Your active trading hours are from 7 to 12, or sorry, from 7 to 10:30, Daniela. So now you have a schedule, and your whole day is not staring at a chart. Your whole day is doing what you need to do, being responsible. And I can't believe I have to say this, but put down your phone when you're driving. When I was first trading with one of my friends, he used to watch his trades while he was on the phone. Okay, and the guy almost crashed. So please make sure you put your safety and your stability with your family above trading, please, because you still have a life to live apart from trading, and the market should not suck up your whole life. They should be a profession that you want to and put in time to study, but your time to study is after 3 and before 10. Whenever you want to do it is whenever the hell you want, but you have a schedule. Now let's say, let's do another one. How about you, Enrique? Are you still here?
Yes, sir.
Let's go ahead and make a schedule around you if you're okay with that.
Yeah, that's fine.
All right. So what time do you usually wake up?
I usually wake up around 6. I'm in Central Time.
Around 6 Central Time, so around 7 New York session. Perfect. When do you usually go to work?
I work from home, so I actually have time that I can move around and stuff like that.
Perfect. Amazing. You could, while you're working, and if you're comfortable with it, you could, have you could have your charts pre-marked up, and then you just look for entries and execute during New York session, right? And during that New York session, you start from 7 and you go to 12, and it doesn't have to be staring at the charts. You have your trading view alerts. Use the tools that are given to you, right? Trading view has alerts. MetaTrader has really complicated alerts, but TradingView for I think $15 a month gives you unlimited alerts. So just press your alert, and then when your phone buzzes, hey, price is crossing this position, then you go on lower time frames really quickly, and you go, okay, distribution, here we go. Boom, you enter 3-pip stop, you make your whole paycheck for the week. Okay?
Yeah, before I came with you, I was doing the complete opposite. I would I would stay up till 3, 4 in the morning, and then sleep for a couple of hours, and I didn't know what I was doing, to be honest.
Yeah, isn't it exhausting?
Yeah, super.
Dude, oh my goodness.
I was actually starting to hate it, to be honest.
Yeah, it becomes so much of a drag. Trading should be something fun. It shouldn't be something. It should be serious, but it should be fun. Right, it ruined my sleep schedule. It's what I've been doing. You should not be ruining your sleep schedule or putting trading before your health. Disclaimer. Okay? That is something that I want you guys to take away from this. Take this thing that I just gave you and make your own schedule. Find time. Find time to trade and find time to study. Because if you really want to make this your job and you really, really want to get good at this, you have to put in the same amount of hours I did. Now, you can learn from my mistakes and not stay up every London session for a year. You cannot take 18 credit hours plus robotics plus a sport and trading, staying up every single London session. Okay, you cannot do that, and you can do it the proper way, how I'm teaching you, and take New York session, take Asia session, take London session, and work around yourself. That's what you should be doing. Okay, and that is what I want you guys to do. I hope you guys learned something from this. And I
One
hope
quick.
these last, oh, go ahead, Daniela.
I'm sorry. So this time is the same as the central time?
No, so Central Time is 1 hour back. So if
Okay.
this was 7 p.m. Eastern, 7 a.m. Eastern, it would be 6 a.m. Central, I think.
Okay, because that's what I've been marking, and I thought I did it wrong.
Yeah, these are all Eastern. Can you do
Okay,
mine?
so I was gonna ask the same thing just to try to get a sense of what I should do.
Yeah, sure. So Lauren, let's go ahead and do your schedule.
For sure. I just started working in my job, so like literally I'm up all night, early mornings, really before even when I had a job. But
Okay, so you work at nights?
I used to work on the weekends from Saturday to Sunday, 40 hours.
Okay, so when do you usually wake up?
During the week or on the weekends.
Whenever the markets are open, so on the week.
During the week I usually up early in the morning, about 6 o'clock.
Around
7.
6 o'clock? Okay. So 6 o'clock, 7, you can be trading your own New York session. Let me mute you right quick while I explain, because I can hear myself and it's pretty distracting. I'll let you unmute once you have something to say. Give me just a second to explain it. So essentially, you can be trading New York session, right? You can be trading 7 to 12, and even if you have a light type of work or something like that, you can use your trading view alerts. If you don't want to, you can trade your Asia session, right? And you can use Asia session to your advantage and simply say, okay, what was the result of New York session? Let me go ahead and see what ranges I'm in for Asia, and let me see what setups I can put my limits at. Asia is very, very heavy limits. So you have to get really, really good with your limits, meaning like saying, buy limits, spotting order blocks, spotting liquidity rates, stuff like that. You have to get really, really good at it if you want to specialize in Asia session. If you want to specialize in London session, you have to get really, really good at dynamic entry, meaning that you have to get really, really good at your emotions, right? Getting really good at watching trades move very, very fast. And for New York session, you just have to be good, right? You have to be really good, because you have to make sure that you're watching for these schematics, and you have to make sure that you're watching fractal price. So for you specifically, I would be using New York session to your advantage, or I would be using Asia session to your advantage. Whichever one you feel more comfortable with, you could use one or the other.
What time does the Asian session start?
It starts at
Like
6
for
p.m.
I'm in
Eastern.
Missouri.
What time zone are you?
I ain't gonna count. I don't even know the time zones.
What state are you in?
I'm in Missouri.
You're in Missouri. You're
Time is
central.
it where you're at?
You're central time.
I'm on the same. Yeah, I'm same time as Texas.
Yeah,
Oh,
yeah.
okay.
So you're central.
All
So
right, for
you
sure.
would be waking up around here. Give me 1 second. So you'd be trading from 6 your time to 10 or 11 my time. Okay, so you'd be trading from, let's say, let's subtract 1 hour, so it'd be from 6. So let's do it this way. For central time, It's minus 1 hour. For mountain time, it's minus 2 hours, my fault. And then for Pacific time, it's minus 3 hours. Okay, so depending on your time zone, these are the times that you essentially do. So if New York session is at 7 for me, for Eastern, for Central Standard, it's at 7. Sorry, for Central Standard, it's at 6, and it ends at 11, right? The kill zone. For Mountain Time, it starts at 5, and it ends at 10. And for Pacific Standard, it starts at 4, I think, and ends at 9. Okay, so for people that possibly live in the PST area or in the mountain area, maybe London session would be better for you, because it starts around what, midnight, or a little bit before midnight. It starts around like what, 10. So you could be using you could be using London session to your advantage depending where you live in the US. Or if you don't even live in the US, trade your time zone. Say you live in France, or say you live in Africa. You can easily trade London session. It's during the day for you, which will be fine, right? It all depends on you finding the right volatility, either on London or New York. You can catch either one of these. One or the other you'll be able to catch. And Asia will be kind of that fallback for you, so that you can easily just kind of say like, okay, maybe I don't have time today, or I have a lot more schoolwork than I thought. Let me go ahead and just mark up Asia and set my limits and be done with it. Does that make sense to you guys?
Yeah, appreciate that for sure.
All right. Is there anyone else that would like to go over the schedule, or that will probably be the beginning of the question and answer section, and then we will go ahead and end the bootcamp for today?
I would, just because, but I kind of have a sense that I would probably be in New York though, because I work a regular, 9 to 5:30. That's my work schedule.
Okay, 9 to 5:30. Okay,
Yeah.
so for 9 to 5:30, you could use Asia to your advantage, or you could just trade New York session and use your trading view alerts. Using your trading view alerts, marking up during Asia and then executing during New York, you could easily just look at your lower time frames once your alert goes off, and then just mark the lows, mark the lows, mark the lows, wait for the low to get murdered, and then catch the retrace, and then from there, boom, you catch your entry, right? That makes sense to you?
So chart during Asia session. So
Mm-hmm.
basically, like when I get off of work, chart during Asia, and then when I wake up in the morning, that's when I start placing my trades in New York.
That's when you set your alerts on TradingView, because remember, you shouldn't just be placing your trades out of nowhere. You should be placing your trades out of basic structure. So once price goes into your structure or into your kill zone, then you set your alert, and then you look over at your phone or at your laptop, and you say, oh, perfect. All right, now I can go into my lower time frames and spend a maximum of like 10 minutes here and catch my entry and be done for the day. And then you can go focus on work, so you're not stealing time.
Right.
That's the beauty of being a professional trader and knowing what you're looking for. Because a lot of people don't know even what they're looking for, and that's why they get stuck on their job. Oh, that's why they get stuck on their phone and they get fired. I've seen a lot of people get fired. However, you don't need to. Why? Because you're a professional trader, and now you're trained by Hex, and now you know what you're doing, right? Perfect. So now let's move on to the question and answer section of this boot camp, so we can go ahead and end it. I'm going to do a quick outro for YouTube, and then I'm going to go to the question and answer section. Okay, so don't leave yet. Thank you guys so much for watching. This is going to be the end of bootcamp day 1. For anybody that could not make it, I'm going to put this on a restricted mode, so only the people that ask for access will be available. If you click on the link and it says request access, make sure the email that you use matches your name, and I will cross off whoever has it and whoever doesn't for a maximum of 2 time views. And then from there, you guys will be able to watch it if you missed it. Okay. So just shoot me a DM. Let me know if you need it. This is available for my downlines and my downlines to keep it within the group. However, I will be sending it to the higher ups as well. If you're listening for, Cam, EP, everybody else, I will send it to you specifically and directly. So thank you guys so much for watching. I appreciate you guys for coming. And that is going to be the end of today's bootcamp. Make sure you guys are up and ready on Wednesday when bootcamp part 2 will be starting. Okay, I'm going to skip Tuesday because Tuesday I have a couple things that I need to do and I have a lot of work to do. But Wednesday we will return and we'll continue Wednesday, Thursday, Friday, Saturday. Cool. All right. Thank you guys so much for watching. Leave a like and thank you guys.